Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Fresh UK jobs data crossing the terminal now. What will it mean for the Bank of England's rate path ahead? We will bring you all of the numbers. The Bank of France cuts its domestic growth outlook, warning political upheaval is hitting households and business confidence. Plus, Germany's election campaign finally gets underway, with Chancellor Olaf Scholz calling for new investment in infrastructure and defence.
In the meantime, a quick check on these markets. Red on the screen when you look at the futures picture. Eurostoxx 50 futures down by about 0.3%. The FTSE 100 down slightly more, down by about 0.4%. I've got my eye on the currency picture because euro dollar earlier in the session hit 104. As Anna mentioned, we're still working through the politics in France and Germany as well as weakness over in China. 7.29 on that currency pair. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. We mentioned it in the headlines. UK jobs data moving right now, and it's moving the pound. Let's get straight to that then. Really coming in pretty hot, Kriti, compared to expectations. 5.2%, the three-month number year on year. And this was against an expectation of a rise of 4.6% and a prior reading of 4.3%. So we were expecting this number to go higher, but we certainly weren't expecting it to go almost one whole percentage point, one whole percent higher. So that's certainly a really quite staggering move in terms of the wage story. And does this reinforce expectations that we do get a hold from the Bank of England when we hear from them later on this week? Thursday, of course, is the next meeting. There is an expectation in the market already that we get a hold, but does this mean that they're even more cautious about their cutting, given what they're saying here? We do know that the growth story is also under pressure. We saw that in the GDP data last Friday, and then that PMI data yesterday showing that jobs were cut in the wake of the budget. So not adding up to a very positive picture when you add all of those things together in terms of the UK narrative.
Exactly, and you mentioned this and when you were reading the headlines there, the pound almost at a 127 handle now. That's a pretty decent jump for that data, perhaps justifiably so. But I think the commentary here matters. We know the Bank of England has been historically reactive to single data points, maybe more so than their counterparts around the world. Is it the labor market story that matters more, or is it the inflation story that matters more? Because over in the States, for example, or even in the ECB, you see them counter to each other. You're not seeing them on the same page. I wonder if that applies to the UK.
Yeah, and we have a great guest to talk about this. Karen Ward joining us later, Chief Market Strategist, and she was talking about this bad combination of weaker data and sticky inflation in the UK, and we see that evidenced very much this week. Let's talk about one of our other sort of go-to subjects on this programme, Kriti, which is French politics. Bank of France in focus, as well as the politics.
It absolutely is. Well, let's kick it off with the Bank of France. Their growth picture is taking a pretty decent hit this morning, and it came out, I believe, last night here, where they're talking about a only 0.9% increase when it comes to the growth picture for France. And this is something that we've seen already perhaps reflected and even maybe foreshadowed from some of the credit ratings, but also in the idea of the business consumer kind of survey that we had a couple of days ago as well, where the political instability is affecting people's willingness to invest, willingness to operate in that country. And already that's showing up in the figures.
Yeah, absolutely. And so the Bank of France talking about uncertainty in the fiscal consolidation, and this is causing uncertainty for business, for consumers, as you mentioned. Meanwhile, the conversations about forming that government carry on. Le Pen says she feels listened to. Whether what was talked about with Prime Minister Bayrou will have an impact, we'll wait to see. But certainly she felt that she was listened to. He also spoke, Bayrou also spoke to the socialists, so we know that conversation is ongoing. The spread now at 79, Kriti. It's climbing again, kind of slowly, but it is climbing a little.
Yeah, steady and gradual. And as long as it is steady and gradual, not a shock to the system, it kind of feels like France is getting a little bit of a pass that they maybe didn't 6 months ago. And that's a similar story to other parts of the world where deficit and growth concerns remain firmly in focus.
Yeah, let's talk about China, shall we? Nice baton pass there. Let's talk about China, because we've had some news out from the Reuters news agency first off this morning, talking about the deficit and also the growth targets there. They were putting this growth target for 2025 at 5%. That would be bang in line with this year's target. Officially, we won't hear about that number until March, it seems, but that was pretty much as the market perhaps had been expecting. We did see some interesting movement around the budget deficit, though, some suggestion from their reporting that this would not be 3% as it is in 2024, but it would rise up to 4%, which is quite a big, move if you're at 3 to go to 4, you might think. But then some people within Bloomberg asking whether this is going to really make any difference to domestic demand, and that's a question we'll certainly pick up on later in the program.
I think we talk a lot about this from an investment point of view. That is China investable again if you start to see this kind of big stimulus measures and the government come out in force. But if you look at last month's data, that has not been the case. As a result, you've seen a massive exodus in terms of Chinese flows, a record speed. The tariff threat certainly weighing on it as well. It feels like initially you could have these kind of growth targets change and the stimulus, but at the end of the day, is there that believability factor? And this morning, if you look at the Chinese yuan, we're looking at 729 against that currency pair versus the dollar yuan, 729 is where we're looking at. That believability piece is not showing up in the markets this morning.
Yeah, and really interesting. We did have that little bit of a spike upwards in the CSI 300, but it did look to be fairly short-lived, really quite short-lived, and some suggesting that will bode ill for European stocks, the ones that, of course, are very attached to the Chinese consumption story. Let us go through some of the guests that we're going to be talking to then, Kriti, this morning. Karen Ward, EMEA Chief Market Strategist at JP Morgan Asset Management, will be with us, the perfect voice to think about some of these dynamics in the European market right now, and the read across from China. Max Layton, thinking about read across from China, will be with us. Global Head of Commodities Research at Citi. There's certainly a substantial influence from the China narrative there. And we'll keep focused on all things French, the French economy, the French politics. Valérie Pécresse will be joining us, Regional Council President for Greater Paris, to give that perspective on the growth story out of Paris, out of France, and indeed the politics.
Some pretty incredible guest lineups that we have. You're certainly going to want to stay tuned for the whole 2 hours. But then we, of course, are also counting down to some crucial data coming out of Germany. At 9 a.m. UK time, German IFO data is going to be hitting the wire. We're going to be talking a little bit about what is actually impacting the sentiment on the ground there in the face, or in the countdown, I should say, to that February 23rd German election. 10 a.m. UK time, just an hour later, the German ZEW, I'll say ZEW survey comes out as well. And, of course, then the baton shifts to North America. At about 1:30 p.m. UK time, U.S. retail sales, maybe a little bit of insight into the holiday shopping mood over in the States, plus, of course, Canadian CPI there as well, happening at about 1:30 p.m. UK time. But
you do you, Kriti. You say Z.
I know, but
it feels
like
weird.
I know. It feels very unnatural, but there it is.
Don't do it to yourself. Don't do it to yourself.
But the countdown really is German data. I think that's the highlight for Europe this morning.
Yeah, absolutely. So they come mid-morning, don't they, European time? It's quite unusual to get both of these data points on the same day, so we get a sense of how the investment community is feeling about Germany and how the business community is feeling about Germany, and both of those could be really interesting. Again, we roll that in, though, with the politics, and we'll hear more from the CDU-CSU later on today, Friedrich Merz and his counterparts. We will hear about their plans for the German economy. We talked a lot about the debt brake yesterday and whether they would persist with the debt brake, how they might modify the debt brake. And so that conversation, as we build towards those elections in Germany early next year, will certainly be front and centre.
It will be. And I'm curious, ahead of this data, it's coming in about 2 hours' time, you're all flirting with that 104 handle. And I'm curious how much of that weakness you're seeing this morning is a function, perhaps, of the expectation that the data may come in actually quite weak, when we have seen the German story, of course, move the euro more than the French story has.
Yeah, indeed. And just looking at the annual growth rates, Germany is set for its second year of contraction. We know the energy story really well. We know the drag from Chinese growth really, really well. But all of that adding up to difficulty for the German economy for yet another year. And
we're going to have plenty of conversation about how that shows up in the markets and, of course, how it shows up in the politics throughout the rest of the program. Let's talk about what else we need to know this morning. Local officials in the French territory, Mayotte, fear as many as 1,000 people have died after tropical cyclone Cheeto hit the archipelago off the coast of Mozambique on Saturday. Emergency crews have worked to rescue survivors with water, power, and communications cut in what was the worst storm to hit the area in nearly a century. President-elect Donald Trump is urging Ukraine to reach a deal to end the Russian invasion. Trump saying that it would take a century to rebuild Ukrainian cities leveled by the war, brushing aside Ukrainian hopes of recapturing seized territory. He added more criticism on the use of U.S. weapons to strike targets deeper into Russian territory, suggesting he may not extend that authority if fighting continues. And sticking with the Trump story, Canada's finance minister, Chrystia Freeland, has resigned from Prime Minister Justin Trudeau's cabinet, all over differences over how to prepare for the incoming U.S. administration. Freeland's resignation letter cited, quote, aggressive economic nationalism and the need to keep fiscal powder dry in case of a tariff war. The sudden departure has shaken the Canadian government, with opposition leaders now calling for an election. This is pretty staggering that you're starting to see this kind of strategy that we've seen a lot of European leaders, a lot of course, Asian leaders as well, and now Canada talk about how you deal with this. to the point that it's creating division within government.
And could force another election. We thought 2024 was the period of peak election, and probably it will be. I'm not sure we can repeat them all. But certainly this would be something that could bring forward an election in Canada. And you're right, there are links to the Trump administration here, aren't there? Because she was very open in this criticism that does seem to have brought the Trudeau government to the edge, talking about keeping our powder dry. We don't know what the Trump tariffs are going to bring, and so we need to do that. And really pushing back against some of the giveaways that Trudeau has been trying to push through in terms of the fiscal story as well, which I wonder if this has broader read across to other geographies as well. Talking about these fiscal giveaways as making the party look unserious.
It is, and I think the strategy is worth highlighting here as well, because Justin Trudeau, Christian Freeland said that as well, this idea of economic nationalism. Justin Trudeau has been considering and mulling this idea that there may actually be a way to almost use the stick approach instead of the carrot approach when it comes to tariffs. This idea of you cut down on permits, you cut down on licensing, you cut down on imports from refined oil and other products into Canada as well. That's very different than the approach, say, that the EU is taking, for example, where they're saying, well, maybe we could actually buy some more of that natural gas as a way to avoid bigger tariffs. That might be a solution. But Canada and other governments taking two very different approaches.
OK, so we've had so many examples today of stories where politics and economics meet, from Germany to France to Canada. We'll continue to monitor all of those, of course. We also have some corporate news flow to focus on. Coming up, Bloomberg has learned that CVC Capital Partners is exploring a potential purchase of Vivendi's stake in Telecome Italia. We will discuss what it means for Italy's largest telecom company and whether a full takeover is on the table. That analysis coming up later in the programme. Plus, we'll look at how Novo Nordisk's rapid hiring spree in Denmark is making it difficult for smaller businesses to find staff, leading some to close down. We also, next, we'll have a conversation about rates here in Europe and beyond. We'll be joined by Pooja Kumra, Senior European and UK Rate Strategist at TD Bank. If you want to get involved in any of these conversations, please do. IB plus BBTV Go. That is the function on the Bloomberg terminal. It's dark, it's early here in London. This is Bloomberg.
Expectation is that they will continue to do rate cuts in 2025, and I think the dot plot will show 2 or 3 rate cuts in 2025. But to your question, what would cause them to not just pause but to stop? That'd be an economy that continues to do better than expected, inflation that's sticky, and the Fed revising up their estimate of what a neutral interest rate is.
Where is neutral? The ongoing conversation. Bloomberg opinion columnist and former New York Fed President Bill Dudley speaking there. Now, the Nasdaq has hit yet another record yesterday, helped by Broadcom once again, which has surged by 38% in just 2 sessions. With more on that and other moves we need to keep across, Bloomberg's Valerie Teitel. Good morning, Val.
Anna, it's looking like the Santa rally we're getting this year is a broad tech rally. We've seen the Nasdaq hit back-to-back all-time highs on Friday's session and on yesterday's session, bringing the year-to-date Nasdaq gain nearly to 32%. A lot of that did hinge on the rally we saw in Broadcom shares. Its 2-day rally at 38% since it reported earnings last week took the market by surprise. But what has also been surprising is just the lack of breadth that we have seen in December's rally. If we look at how the Mag 7 has traded to the equal weight S&P 500, its outperformance is the biggest that we've seen in over a year. It has been a very narrow rally, Anna. Nearly 80% of the stocks in the S&P 500 are actually in the red for December. But flipping to the risk events that we have on the horizon today, a lot of them focus here in Europe, where we get the German IFO and the German ZEW survey on deck. Now, the IFO survey, the current assessment component is expected to decline, and it's actually at its lowest level since the COVID malaise of 2020. Out of the 5 components we do expect to get today from these sentiment indicators, we're expecting 4 of them to show declines from the previous month. Now, a lot of this pessimism in Europe has been baked into what we've seen in euro-dollar in the FX market. There has been a growing amount of shorts in euro-dollar. If we look at the CFTC positioning data, it's actually the biggest amount of short positioning that we saw since March 2020. So a lot of pessimism. We're still asking that question, just when we hit peak pessimism in Europe. If we look at what's going on in the FX market, it is still on the trajectory downwards.
Valerie, thank you very much. Bloomberg's Valerie Teitel with many of the themes that are dominating markets right now. Let us bring into the conversation Pooja Kumra, Senior European and UK rate strategist at TD Bank. Pooja, thank you so much for joining us. Lots to talk about when it comes to the wider Europe story. Valerie setting that up very nicely in terms of that pessimism narrative. We'll return to that. But I want to start with what's going on with the UK as we wait for Gilts to open. Well, I say wait, 40 minutes from now. So we've had this average weekly earnings data that's come in pretty hot this morning, 5.2%, ahead of the prior reading of 4.3%. The prior reading revised up just a fraction, and well ahead of the survey of 4.6%. So this is quite strong in terms of the wage data. Is this something the market is going to look through? I mean, the pound is spiking on it this morning. Or is this something that increases the likelihood of a hold this week and in the weeks ahead, the months ahead?
Yes, the wage data is definitely strong, and it's above consensus. We knew that base effects would be a big part of this week's wage numbers, but clearly stronger. We can still sell off front end as we open, but I think given the fact that we are not pricing in much for this meeting in December, and the fact that we also started yesterday with a pretty bearish move in UK gilts, I just feel that there's limited potential for further sell-off. But yes, I think markets are very scared about the wage data, and also we have the CPI and service inflation tomorrow as well. So
yes,
that is something I was not looking forward for this number.
Yes, so there's still data to come, and that's an important point, isn't it, Pooja? So yes, before we get to the meeting with the Bank of England on Thursday, we'll get the CPI print tomorrow. We've had a host of weak data coming through on the GDP side, on the PMI side. And I wonder what the labour market story is telling us, because this is really strong wage data. But at the same time, there's evidence of redundancies post the budget, and we know what tax changes might have prompted that. How are you assessing the resilience of the labour market in the UK?
I think in UK, it's the issues that BOE is grappling with is very different from other central banks, to your note. We do think that wage market, labour market is weakening, and that was visible in the employment index that was released in yesterday's PMIs, where most of the private sector said that they will have to take the hit from the NIC increase, right? So it is a big part of the move in...
Pooja's just going to silence her phone.
Oh, no worries. She's an important person. She's in demand.
No.
It's very early. Yes, thank you.
Sorry.
It's all right.
So, I mean, if you saw the employment index data, it did highlight the fact that the private sector is not hiring that much. The private sector is the weaker side. And all the surveys since the budget have highlighted this point. Even BOE is looking at the DMP surveys. So from a BOE perspective, they're actually looking at all these Indeed data, DMP, REC, KPMG, and all are showing the weakness in labour market. So I think they will be relying more on that.
And yet the wages are strong. Well, at least stronger than expected.
I think when it comes to ONS, everyone is a bit doubtful as to how much we need to read about it. And I think it's only in Feb they will actually see more into whether it's just the public sector-driven rise in inflation, or is it just the private sector also getting hurt.
Let's expand this to broader Europe as well, because there's a big conversation right now, of course, of the French debt story. But I'm almost more intrigued by the German debt story. How believable is the removal of a debt brake?
It will be controversial. When it comes to debt brake, we should remember just at current levels, it's at minus 0.35%. So we are not looking at a deficit that possibly France or Italy has. But it will be reformed. It's very likely, because Germany is facing through structural issue. But it won't be that straightforward, because we, again, will be are caught in a three-party system to form majority. And actually to get something that can revise the system that easily is clearly not likely. So we do think that it will be revised to actually work through the structural issues. And that's why Scholz government actually came down, right? They wanted to reform the economy. So that is something, but I doubt it will come as soon and as fast and big as markets are expecting.
But what does that actually do? Because, and correct me if I'm wrong, my understanding here is that if the debt brake is removed, in theory, however long that ultimately takes, it almost creates and exposes Germany to the same issues you see in Italy and France and Spain, of this kind of massive debt burden as well. Wouldn't that create kind of a capital exodus, basically, from German debt? Is that something that may be on the horizon?
No, certainly that is one of the key risks for 2025 for us. Is not only German fiscal, we are talking about EU Draghi's project, right? Like when all the central banks, and ECB is endorsing Draghi's project right now just because the issues are structural. So we do believe that it is creating chaos in the market, and that is something that is visible in how swap spreads have been trading, which is swap minus your bond rate, which has been collapsing because markets fear the kind of fiscal that is entering the European government space. But it's just Germany that we know that it's all going to be within the debt brake. They are trying to reform it and not try to do a big fiscal, i.e. give money to the rich. I don't think they want to spur inflation right now. But the fiscal will be a key theme for Europe next week, as that's the only way they can sort out their issues.
Yeah, that's interesting. And we talked a lot yesterday about whether the debt brake is on or off, or whether it is reformed, and you've talked a bit about the reforming there. Pooja, let me ask you about peak pessimism. Guy likes to ask, Guy's not here today, but when he is here, he likes to ask if we've reached peak pessimism on the European narrative yet, the Eurozone narrative, or do you, in terms of growth, or do you not think we're there yet?
I think we are there yet, and in fact, from a tactical trading perspective, I have actually like being long treasuries versus bonds here. I just feel that given how, ECB clearly has given clear signal about their reaction function, and they will be cutting rates in consecutive meetings. But will they go much below neutral? Because data also comes in cycles. And I think that's where, to your point, I feel that possibly we could see some turning in data, possibly even also driven by people with firms front-loading all the Trump's tariffs. So Q1 could be possibly stronger when it comes to investor sentiment. And I think that is something that we saw even in yesterday's PMIs. The services sector was still stronger in France and Germany. So I do feel that there is a lot of pessimism, but it is very well priced.
How exposed is Europe to what goes on in the States? And I ask this at a time when we're expecting major policy divergence between the ECB and the Federal Reserve. But is there a point where if you see inflation tick up in the United States because of the aforementioned kind of tariff threat and et cetera, is there a bleed through into Europe? And is that something that needs to be priced into the debt?
So when it comes to inflation, the impact should be minimum. The key is how it impacts growth. And it can take close to 0.3% from growth in 1 year from Europe. And the key areas that will be hit is Germany, Ireland, and Italy, who are most exposed to US when it comes to exports. I think what is a worrisome bit, and that is something that was even flagged by IMF's outlook, is the fact that the uncertainty element, the financial conditions element, and that can actually take away 1% of GDP from Europe. So if Trump comes on day one, gives his plan, at least everyone is well prepared how to work about it. But if there's just constant lingering of tariffs are coming and I think that is what can take a lot from hurt financial conditions and as well as growth. And that is the fear factor for the entire world right now.
That's a really good point, isn't it? It's about the level of the tariff, Kriti, when Trump gets into power once again, but it's also about the certainty you have around those tariffs. And if we are without certainty for a very long time, that could certainly weigh on sentiment.
And you're already seeing that in the UK on the plus side, and then on France on the negative side. Yeah. Pooja Kumra, we'll leave the conversation there. Senior European and UK rate strategist over at TD Bank, joining us this morning. Coming up on the program, we're going to pick up on that conversation, especially around Germany. Campaigning starts there ahead of an early election in February, with concerns that political gridlock could hurt the embattled economy. We're going to talk about that. We're going to talk about plenty more. In the meantime, these markets, Eurodollar at a 105.07 handle. You look at the futures picture, red on the screen across the board. Eurostoxx 50 futures down about 0.3%. Underperformance in the FTSE 100 as well. Where is that a consequence of? Because even if you look over in the States, you are seeing U.S. futures down 0.2% and a bid into some of your traditional hedges. That and more after this break. Stick with us. This is Bloomberg.
Welcome back to the opening trade. 30 minutes until we get that opening trade here in Europe. So let's have a look at the futures picture, as Kriti was saying, as we went into the break there. We see weakness across European equity markets. Eurostoxx 50 futures are weaker. We saw fluctuation in Asia around some lines coming through from the Reuters news agency around Chinese growth. They were talking about 5% growth target for next year. We won't get confirmation of that until March. They were also talking about a 4% budget deficit. Will that be enough to reignite animal spirits in China? Chinese markets seemed undecided, a little impressed to start with, but then less so. And it seems to be that negativity spilling into the European expectations. Futures are a little weaker for Europe. Let's have a look at the bond markets, because here again we have some interesting news to keep in mind as we look at the French 10-year yield. now still above that 3% mark, 3.05, and we actually have pushed above 80 on the French spread once again. So these moves coming in a calm fashion, but we are seeing upward pressure on that yield spread between France and Germany once again. Political turmoil in both places, though, as we know. Thinking about that politics, let's talk about the German story. Campaigning has started in Germany ahead of elections in February after lawmakers backed a confidence motion pushed by Chancellor Olaf Scholz. Let's get more now with Bloomberg's Oliver Crook, who's in Berlin. So, Ollie, we've had that vote, the no confidence. It was procedural. We knew that he was going to lose that. And so we set a course for another election early in next year. Where do we go then next?
Yeah, that's right, Anne. I mean, listen, it was the expected outcome, but it's still sort of significant. Obviously, it's a significant step for Germany, for the Olaf Scholz government. And also, you know, there's only the second snap election that's ever been called in Germany, basically since the fall of the Berlin Wall and reunification in Germany. So sort of, you know, significant from that point of view. And the vote came after this really very spirited sort of debate that was held in the parliament about 2 hours before the voting began. And this was really, for many people, kind of the kickoff of the campaign event, with really people being very quite I would say quite, you know, as far as German politics are concerned, quite spicy, quite sort of aggressive. You had, you know, Olaf Scholz talking about the FDP, the sort of former finance minister, Christian Lindner, saying that basically the party was morally unfit to govern. Friedrich Merz from the CDU saying that Olaf Scholz was basically a failed chancellor. And then you had the AfD, this sort of increasingly unignorable force in German politics, the far, far right, 20% of the vote so far leading up into that election, basically saying that Germany is on the brink of collapse and that a vote for Friedrich Merz and the CDU is basically a vote for a war with Russia. So that was some of the rhetoric sort of leading into this vote. Then Scholz went to the president to sort of brief him on the matter. The president will then dissolve parliament, and that will set the stage, as you say, for that election on the 23rd of February. What we are watching for today is we are going to get the party platforms. These are the official documents that these parties will be running on from the CDU and the CSU, from Friedrich Merz and Markus Söder. That'll be at 11:30 a.m. our time. And then at 2 p.m. we get the same from the SPD to really get a little bit more policy detail from what we expect from these candidates and what their recipe is to turn this economy around.
So, Ollie, what is that recipe? What's the solution here?
Yeah, so listen, I think that part of the concern, and we've talked about this, I think, a lot in the lead up to the election, is that it feels from a lot of these candidates to sort of treat the sick man of Europe. They're sort of coming with cyclical medicine for what is a structural problem. And I think that that is the concern, that these party platforms will not really include something radical enough that really sort of faces and meets the challenge that is facing the German economy and the structural issues that are behind that. I mean, we heard from Olaf Scholz yesterday. He is going to focus on spending on infrastructure, spending on defense, but of course he also wants to maintain that very sort of large welfare state within Germany, which, you know, a lot of the critics say perhaps needs a bit of trimming. Certainly the critics coming from the CDU, whose sort of recipe is to cut taxes, to cut bureaucratic burdens, and also and sort of try to stimulate business that way. The problem is that that does not quite, I think, match the seriousness of what Germany is facing right now. And when you actually look at the polls and the breakdown, there is no way that a single party will obviously be able to rule on its own. So you get back into these coalition discussions, likely between the CDU and the SPD, and these are two parties that have very different ideas about how to spend money. Can they really reconcile them, or are we just set for another sort of path of paralysis? To say nothing of the facts, we made a lot of this at the time, but really everybody in Germany is watching the inauguration of President Trump. This is the biggest trading relationship for Germany now. If something goes wrong there, we're talking about an economy that is going to go from bad to worse, and that is very present in everyone's mind here.
Yeah, and Oliver, it takes quite a while. Just remind us of the timescales here. You mentioned that the CDU, CSU is not looking in the polls as if it will manage to achieve an outright majority, which means we go into, once again, coalition talks. And that can take quite a while in Germany. So even when we get to the date for the election and we get the results of the election, still forming a government can be some time off.
Yeah, exactly. And this, you know, and also there is also the other added fact that, you know, I mean, the CDU with 31%, we'll just go through the sort of the numbers here, 31.5% on the latest polls, AfD at about 20%, SPD at about 17%. If you take just those pure figures, you don't actually have enough votes from the SPD and the CDU to even have a sort of over 50%, right? So that tells you something. Of course, that doesn't take into the full accounting. If certain parties drop out, those votes will sort of migrate. But this is sort of at the heart of the question about governability in Germany. Germany and whether or not they're going to be able to pull something cogent off. The sort of silver lining of having radical parties from the far right and the far left rising in the polls. You know, we haven't talked that much about the far left, but there's a new sort of party that was founded earlier this year. She has managed to sweep into about 7 to 8% of the vote. Is that it might push the center a little bit together in order to be able to build that consensus. But that failed really spectacularly last time with this traffic light coalition. So I'll have to see if there is appetite to do it again. We should also say that Friedrich Merz is not the most beloved candidate here in Germany, so there is still a chance for them to lose some ground there, which would make it even more complicated to build a government afterwards.
Certainly something we're going to be keeping a close eye on. Bloomberg's Oliver Crook reporting out of Berlin for us this morning. We'll switch from Germany to the UK, where the pound is strengthening this morning as wage growth accelerated more than forecasted. Average earnings, including bonuses, rose about 5.2% from a year ago in the 3 months going into October. Dan Hansen joins us around the table from Bloomberg Economics. Dan, your immediate reaction to the data?
Big surprise on the wage growth data. I think what we've been looking for over the course of this year into next year is this sort of modest and slow deceleration in wage growth. We were expecting a bit of a pickup, but not as much as we saw in the data there. So I guess if you're sitting in the Bank of England, what are you thinking? You're thinking this isn't in line with our forecast, this is above our forecast now. The labour market is slowly loosening, but I think it's the wage growth number that's going to focus them. And if you're thinking to Thursday, you know, there was a possibility that you might get, I think there was a risk potentially you might get more dissenters voting for a cut on Thursday. We think it'll be 8-1. I think that risk has gone essentially with this data. It's really hawkish data.
Yes, we were talking to Pooja Kumar from TD earlier on, and she was saying, you know, it doesn't actually change expectations for this week, really, does it? Because, you know, a little bit hawkish just reinforces the hold expectation, doesn't it? Because there's no expectation that another outcome is likely. Talk us through the labour market story then, Dan, because on the one hand we have this wage growth, it's substantially above inflation. You know, that might be bad for inflation, that might push inflation higher, but it also might be good for growth, I suppose. But on the other hand, we do have this talk about job cuts, and post the budget there was talk about job cuts. So what are we seeing in the overall labour market?
I think the big takeaway from the UK labour market is that we've gone from a place of what I would call extreme tightness coming out of the pandemic. The labour market was extremely tight. That pushed up wage growth to, you know, above 8%. We've had a cooling in the labour market, but I think what is surprising everyone is the extent of the cooling that is required to bring wage growth down. And that's what we've got from the data today, is that you've got the labour market cooled. So payrolls are continuing to ease. I know we've got trouble with the labour force survey, but if you look at payrolls, you look at vacancies, they're all coming down to pre-pandemic levels, and growth in payrolls is slowing to a crawl. But the interesting thing, I think, is that that isn't enough to slow wage growth. So the key thing about wage growth, and the thing to remember, is we're up at 5.2% today, but you need about 3% for it to be consistent with 2% inflation in the UK, because productivity growth is so weak. So you've still got 2 percentage points to go, essentially, on the headline measure. And if you look at forward-looking surveys, like the Decision Maker Panel, pay awards for the coming year are around 4%. So we're maybe going to get another percentage point, but there's still another percentage point to go. So I think that is the interesting thing. And if you think about how the Bank of England are thinking about it, they think the labour market needs to loosen more to bring pay growth down. And I think that sort of reinforces the view, the sort of consensus view at the bank at the moment, that you need some more loosening in the labour market.
OK, and we care about wages because of what it can do to inflation, of course, and we get inflation data coming tomorrow, Dan. So the expectation is that the year-on-year figure, just the headline, goes from 2.3 to 2.6. Remind us of what's driving that before we draw links with wages that maybe we shouldn't. Often there are underlying energy stories going on here. But what are we expecting to drive that inflation print?
Yeah, so tomorrow we expect to pick up to 2.6% as well. It's all about base effects, so it's about goods prices. Fell very sharply this time last year, or in November of last year, so that's going to lift the annual rate. We think services inflation will be steady, which is the thing that the bank focuses on. You're talking about the link with wages and inflation. It's that wages affect services prices most significantly. That we think is going to stay at 5%. Again, a couple of percentage points, probably above where the Bank of England would like to see it. So I think going forward, we'll get this pickup, we think, tomorrow. And it's going to stay around those levels for at least the coming year. And you mentioned there what was going on with the budget. I think one of the stories sort of moving into next year was how firms adapt to this rise in national insurance. Will it be prices that they increase? Will it be jobs that they cut? But part of that story about inflation being above target is the assumption that at least some firms will pass that rise in labour costs through to prices.
Yes, so we see some doing one thing and some doing another in terms of how businesses respond to that budget. Dan, thank you very much for that.
Cheers.
Dan Hansen from Bloomberg Economics taking us through the data out of the UK, and we'll certainly watch how gilt markets open in around 19 minutes' time. Coming up on the programme, Universal's Virgin Music agrees to buy Downtown Holdings as the company seeks to bolster its slice of the independent music industry. That and your other stocks to watch next. This is Bloomberg. Welcome back. This is the opening trade this Tuesday morning. It is the 17th of December, and we have a lot of red on the screen, it would seem, for European equities. And some of this downdraft possibly coming through in terms of more negative sentiment around the growth story in China, or perhaps the fiscal spending story more specifically. Now, Reuters is reporting that Chinese leaders have agreed to raise the budget deficit to 4% of GDP next year, keeping its growth target at about 5%. Let's bring in James Mager, Bloomberg's senior China economy and government reporter in Beijing. James, nice to have you on the programme. So talk us through your reaction to this reporting, because if it is as presented by other media, we get a 5% growth target in China. That's the same as this year. We get an uptick in the budget deficit from 3 to 4%. Would that be enough to make much of a difference in China?
I think the important thing is not to focus on the numbers specifically. I think 4% is a very misleading amount, because there's a lot of spending that doesn't get counted in that 4% target. And so what I think is the important thing to say is that the budget deficit is going to be larger next year than it is this year. Whether it's 4%, if you add in a bunch of other bonds that are off balance sheet but are still guaranteed by the central government and are used for very similar purposes to on balance sheet spending, it's probably going to be likely closer to 8%. And so, whether it's 6 or it's 8 or it's 4, I think the important thing is that the government is saying they're going to spend more next year to try and drive growth and to make growth be stronger than it was this year. And I think also with the 5% target, I think, it's about 5, it's going to be about 5 again next year. I think, it's important to remember that's a real growth target, and actually nominal growth, which is what really matters for both the size of the economy, but also for things like debt service. Nominal growth this year is going to be closer to 3.8%, 3.9%, because the economy is in deflation. So what the government is really saying is they want the economy to grow about the same pace next year as this year, but they're going to have to spend a lot more money to do that. Whether the amount of money they say they're going to be, or this target would indicate they're going to spend is going to be enough, I guess we'll have to see. The first problem they have to get over, though, is that they said they were going to spend about 3% or have a 3% deficit this year, and they're nowhere near reaching that. Their spending hasn't actually reached the targets they set for themselves earlier this year. And so the first thing they have to do is actually spend the money that they're budgeting instead of holding it back like they've been doing for the last couple of years.
Well, James, you laid out some key ways that the federal government is addressing those debt issues and then that economic malaise. But can you walk us through kind of how they're maybe addressing it on a more municipal or local level, given that that's where some of the cracks have been, especially on the overspending side?
So, China's tax system is quite unbalanced. So the central government gets most of the money, and the local governments do most of the spending. And so the way that's been dealt with in the past was basically the central government has to transfer money to the provinces. They obviously weren't transferring enough. And so the provinces have been going out and having all these off-balance sheet borrowings, which have then led to sort of various different kinds of debt problems. So what the central government is now saying is that they can sell more bonds to repay old debts to get new debts that are cheaper. And the central government is also promising to give them more money, though that second part of the promise hasn't actually happened yet. We're expecting next year, maybe in March, at the National People's Congress, which is the parliament session, that we'll see some kind of changes to the tax system where the local governments will directly get more of the tax take. But this is going to be a long process where gradually who gets the money from tax revenue and from bond sales is gradually going to be changed. But Beijing really doesn't want to let go of the purse strings too much, because they fear probably rightfully so. If local governments can tax and spend as much as they want, they're going to do that, and Beijing will have less control over where the money is going and how it's being spent. So, they're trying to create a balance between making sure that some of the poorer places in China don't go bankrupt, but still keeping enough control that people don't become profligate and borrow and spend way beyond their means.
All right, Bloomberg's James Mager reporting for us this morning out of Beijing. We thank you so much for your time and, of course, the breakdown of what's going on in China. Let's get a little bit more of a markets perspective here to everything we're digesting this morning. Markets Live Executive Editor Mark Cudmore joins the program. Mark, we were just talking to James about what that economic breakdown looks like and what that servicing of debt may actually look like. How believable is this for an investor in Asia?
I think James' analysis was absolutely excellent. And I guess the summary is it's a loosening of the purse strings, but a controlled loosening of the purse strings. And I think this validates the ongoing theme that we've seen since September. It's almost 3 months in this kind of narrative now that China realizes the problem was bigger than they previously acknowledged, realizes they need to do more, have realized that markets need to be a focus of their attention and that they're going to care about what markets do and care about supporting markets, both in the property sector, on the stock market side and on private markets. But they want to do it in a kind of a steady and controlled manner. They want a sustained, gradual, slow bull market, not some runaway repeat of 2009 or prior bazooka stimulus methods. And I think that these targets overnight very much align with that. These are good numbers, but not wildly ambitious numbers. They're just solid and positive and encouraging at the margin.
Mark, let me ask you about the fiscal stories then as we go from 2024 into 2025. It does seem that fiscal concerns of many shades, many forms, are on investors' minds. Is it entirely normal and to be expected that bond markets put pressure on some countries like Germany and China to spend more and put pressure on other countries like France here in Europe and others further afield to spend less? And that's just how bond markets operate, and we shouldn't be surprised. Or is there something notable in this?
I think it's interesting. I don't recall a time where fiscal themes were so dominant across so many different markets. So on one side, we've got China and Germany being pressured because they're not providing enough fiscal stimulus. And we have countries from France to Brazil to Canada to India all being pressured because of being too loose on the fiscal side. And then, of course, we don't know what's going to happen with the US because we've got commitments to cut the fiscal deficit and yet policies that don't sound like they will cut the deficit, in fact, that it might increase. So I have never remember a time when fiscal themes were so dominant across global markets, but the reactions were kind of very divergent. And I think that really this is a story of bond vigilantes by stealth, and I think it's going to be a dominant theme across markets over the next couple of months.
Mark, 15 years ago, China's major infrastructure stimulus boosted the American economy as well. Do we see a repeat of that if they continue to pump their economy? Is there a ripple effect?
There's going to be a ripple effect from the support China's providing, but not in that major way that we saw 15 years ago. I mean, the scale of stimulus that they provided back then to the global economy was just immense. And it was at a time when the economy needed it right after the GFC. It hit an environment where assets were not overpriced, were not overvalued, and were ripe for a rebound story. It's a very different scenario now. The world is priced very bullishly elsewhere. The impetus, the ripple effect from China is going to be much smaller. Sure, it's a positive, but not too much. And more of the positive will go to Europe, not the US.
OK, thinking about those trade flows, thank you very much. Bloomberg Markets Live Executive Editor Mark Cudmore with the latest on the markets. You can get all of the thoughts from Mark and the rest of the Markets Live team. MLIV Go is full of commentary on China, on those fiscal concerns globally, what the bond market wants to see, all of that very well covered by the Markets Live blog. Let's get to the stocks that are in focus. Joe Easton from our equities team, of course, is here with a briefing. Joe.
Morning, Anna. So Goldman Sachs is updating its ratings on consumer stocks today, putting a buy rating on Nestlé, largely due to their strength in the coffee space, which they say is expanding. But they do put a sell on the rival JDE Peet's, which they warn it isn't doing as well on pricing, and a neutral on Danone. But the one that stands out to me is Nestlé, because this stock is having one of its worst years on record, down almost 24% on concern around consumers trading down. So that one potentially is going to be a bit of a relief for that one. Then in the music space, we've got a big deal coming for Universal Music's unit Virgin, which is buying Downtown Music, an American firm which says it focuses on more up-and-coming artists. This could potentially provide a boost for Universal, which did tank back in the summer when it warned of a slowdown in their streaming growth. So potentially this could be a bit of a relief for that one as well today. Then in terms of your UK stocks, I've got my eye on the banks, given that we've seen that acceleration in wage growth on a key week for UK data, with inflation tomorrow in the Bank of England on Thursday. The UK banks having a really strong run, including NatWest at the moment, but the home builders potentially going to be hit today, given we might see yields coming up. It's been a bad couple of months for those. Finally, in ratings, a couple in the UK. London Stock Exchange and Marks and Spencer's both have new buy ratings, whereas we've got Airbus a buy over at Deutsche Bank, potentially one to watch in France.
Joe, thank you very much for that. We are going to also be watching if we get another day of moves on Vivendi, Kriti, and Telecome Italia. CVC considering buying Vivendi's stake in Telecome Italia. This broke yesterday. It was priced into markets, but some of the moves were so big. You know, we'll certainly watch to see if we get any movement on the back of that today.
Yeah, we could see a reversal, and CVC, of course, has come to market with a couple of deals as well. Bain also now being reported in some of the Italian newspapers to explore that as well. So that'll be interesting. This is kind of this big theme that private equity is starting to get in these big infrastructure deals, and Telecom Italia, which is one that Maloney has been looking to offload, is just one example of that. We're going to watch all those market moves coming up in just a moment. Futures still substantially in the red, underperformance right here in the UK. This is Bloomberg.
Welcome back. This is the opening trade. A few minutes to go until we get that opening trade here in Europe. Let's have a look at where we were during yesterday's session, how that positions us for the start of today's trading. This is the European session in white, and we went on a kind of round trip, selling off a little. Nervousness around the French political situation was one of the factors, and then making some gains with the United States and the US market open in the blue yesterday. Even without any other news flow, we might have been set for a pullback. You can see the S&P pulling back at the end of the US session yesterday, so that might have been expected to weigh on stocks, Kriti. But add to that the negativity we've had out of China, some Reuters reports suggesting a 5% growth target for China next year, and what some in China are considering to be a fairly unambitious budget deficit target in terms of ramping up fiscal spending. So some of that weighing on sentiment a little bit through the China session. So as a result, the futures picture looks pretty negative. Euro Stoxx 50 futures down by 0.4%. Kriti, what do you see in the individual stock moves?
Well, a couple of moves when it comes to that deal flow. I'm going to kick it off here with UMG, Universal Music Group, of course, listed both in the UK and Amsterdam. It looks like their Virgin Music Group is looking to buy Downtown Music for $775 million in cash. We'll see if that has a read through. We are seeing some early indications that this must be one of the movers. Carlsberg is another, getting a little bit of a green light coming out of the UK CMA, that regulatory authority that was monitoring Carlsberg deal for Britvic, now potentially saying they're not going to move it to that phase 2. And lastly, Bunzl, this is of course a distribution company that really services a lot of the grocery space as well, seeing a small decline in underlying revenue over the entire year. And those are just some of your stocks to watch.
Okay, so we look for evidence of what the China narrative is doing to European stocks today. We'll keep an eye on the banking sector because and the gilt market open because of that wage data we had out of the UK. Are interest rates going to stay higher for longer? What does that do to banks is certainly one of the questions we will be asking. This is the market open then. We have the FTSE 100 down by 0.2%. The Stock 600 yet to open. The CAC 40 yet to open. But a little bit of negativity then coming through on these markets just in the shape of that FTSE move. There you go. The overall Stock 600 then, Kriti, is down by 0.3%. So we do have a little bit of negativity coming through. I wonder if it's concentrated on things that are exposed to the Chinese consumer. If the markets are not overly impressed with the idea, at least, of a 5% growth target, or not overly impressed with the uptick in budget deficit that could be priced into China next year. What does that do to sentiment? The CAC 40 down by 0.4%. The IBEX down 0.5%. Kriti, what do you see in the sector view?
Yeah, underperformance when it comes to the commodity stories. Shell, BP, Glencore, that seems to be where a lot of the underperformance is dragging the stock 600 down, and the UK, I should say, as well. But to the upside in the stock 600, you are seeing a little bit more optimism in France. Despite the red on the screen that you're seeing across all the sector space, there are some of your biggest upside contributors are located in France. I think that's interesting given this kind of political overhang, Anna, that we've been talking about. But right off the bat, I'm looking at Airbus, for example. I'm looking at Safran, among others, that are starting to move. Perhaps a little bit of an aerospace and defense theme that we need to keep our eye out for.
Yeah, those energy names really are the worst performer, aren't they? Down by 1.7%. Any in particular, Total Energies. We will certainly pick up on that theme, not the stock specifics, but what's been happening with the underlying commodities with our guests from Citi. A little bit later on this hour, we'll have an opportunity to talk about some of those energy market dynamics and wider commodities. Healthcare also under pressure then, down by just over 1%. So that's the second worst performing sector. Not a huge amount of positivity. No sectors in the green, Kriti.
No sectors.
I bring you no festive joy.
It's okay. We got red on the screen regardless. There's a little bit of Christmas in there somewhere. But Airbus and Safran, I think, are still getting a lot of volume, and you can see that on your screen right there. The only thing I'm seeing in terms of kind of movement is getting a little bit of an upgrade over at Deutsche Bank. Airbus is a price target of 185 euros. That might be taking Safran with it. Just when we need Guy Johnson, he chooses not to be here. I mean, come on. This is his arena. He would completely nerd out about it. But it looks like that Deutsche Bank stamp of approval is helping it. But net, as Anna was saying, you are seeing red on the screen. Sentiment is certainly a little bit of a frowny face this morning. Let's talk
that's
about
the technical term.
Yes, that's. I'm bringing up the professionalism here. Let's talk a little bit about that political overhang, though, because that seems to be what's navigating these markets. That underperformance in France, largely around those jitters, the political jitters that we're seeing there. BlackRock's Helen Jewell spoke to this program about the diverging picture at Europe's core. Take a listen.
The DAX has had a really, really good run in the last few months. And a lot of that is linked to those constituent parts, the strength of the industrials within them. Unfortunately, what France has got at the moment is the luxury goods, where people are feeling a little bit jittery anyway about luxury goods. And therefore, the component part can't do enough to outweigh the jitters. And on top of that, the jitters around France are certainly greater than the jitters around Germany at the moment.
Joining us now, Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Karen, a pleasure to have you on the program. We were just hearing from Helen there that some of those political jitters may not be reflecting necessarily in those indexes simply because they're constructed in a very different way. And I'm curious what that looks like to you. Every day we see underperformance in France. We say there is a real hesitance to invest in this part of the world. Is it that simple that if there's political uncertainty, you stay away from the index, or is there more to it?
I think often you're questioning, is it darkest before the dawn? What could be the catalyst that's coming out of a period of political uncertainty, economic weakness, which actually then gives you the upside? And I think that's what's underestimated about Europe at the moment. Across the region, the political problems, I think, stem from electorate saying, we need more growth here. So therefore, enough of this fiscal break business in Germany, enough of this talk of returning to austerity. We want a growth agenda. That, I think, is going to feed through not only to fiscal policy, but to regulatory policy, which I think has also really hindered Europe. And I think the penny is dropping in Brussels, that it's time to bring back a growth agenda. It's time to get the region moving. And I think also the other, perhaps first responder will be the ECB. There is a recognition in Europe, if they don't get a handle on growth, these political problems were just at the beginning. So actually, I think, it's one of those moments where the news flow today looks weak, but I think that's going to be the catalyst for positive news in 25.
That catalyst, though, how much of it is at the whim of what happens in the United States? And there seems to be this divergence of even in good times by the U.S. because it's outperforming, and bad times by the U.S. because it's a defensive trade. Where does Europe fall in that?
Yeah, I mean, you definitely have to think about how Europe is going to sit within any trade ambitions of the U.S. I'm working on the assumption that most of that hostility is focused on China. And actually, Europe benefits from being a bit of a friend-shoring partner to the US, that a deal can be done. So I don't think Europe is going to be in the eye of the storm. I think a deal on the Europe buying more energy. Obviously, we are now buying a lot more LNG, replacing Russia in Europe anyway. So I think Trump could speak to some grand deal that he's struck with Europe. So I'm not too worried directly about the trade hostility, but obviously ongoing weakness in China because of the US relationship is going to have ramifications. And that's troubling the market this morning. But again, I think we've got to think, OK, well, what comes next? And I'm not at all surprised that China aren't announcing any great stimulus packages right now. Why would you? Wait till, next year when you're in the eye of the storm and Trump is, unleashing whatever it is he's going to, and then pull out your stimulus package. So it's coming.
But, Karen, what if he doesn't unleash anything? Then
Happy
what?
days.
Is that when you buy Europe?
I certainly think that... two things. One, we have to remember in this whole US versus Europe debate that, yes, the US economy is going to do better under Trump, but that is in the price. That is why you're paying 22 times high earnings expectations for the US market and 14 times lower earnings expectations for the European market. There is not much expected to happen in Europe. So you're always asking yourself as an investor, well, where could the surprise come? And that's where I think we need to have a think about quite how overweight the US you want to be relative to Europe. Because if I'm right on some of the policy catalysts coming through in China, in Europe, then maybe that's where the surprise is. And, of course, we've got to think about how the mega cap tech story plays through, because I personally think in terms of how Europe performs relative to the US in 25, how the tech boom plays out is way more important than who's in the White House.
I suppose that could still point to US exceptionalism, though, couldn't it, Karen? So even if you take away the politics, US exception, I mean, do the valuations get justified by that US tech narrative, which Europe just does not have?
Well, that's the $1 trillion question.
Yeah.
I call this tech story that these guys have A-star student syndrome. For the last few quarters, they've come into the earnings season and they've delivered an A-star report. And it's been outstanding. They are delivering good earnings. The problem is now the market expects them to get A-star forevermore. So if they only come in with an A at any point next year, the market's not going to like it. And I do think they're at the tricky point of getting those A's, stars, because they've created a product. Now they need to sell it. They've created a product. They've invested massively in it, which has benefited the little tech community amongst themselves. Now they've got to go and flog it. And that's what we're going to learn over 25. Is there demand for all these AI products? What is the broader corporate universe willing to pay? This is where it's going to get tricky. So I don't think it's a bubble in any way, shape or form, but I think they are priced for a very good outlook. I'm nervous about that. So for me, it's about risk management and thinking about diversification to some of the less well-hyped stories.
Yes, so we're always looking for signs as to whether they're just still supplying the hyperscalers or whether this is a broadening theme out to other businesses really making the most of the AI potential. Let me go to something. You mentioned surprises, and we got a surprise this morning on the UK side with the wage data coming through. And we see response in gilt markets across the curve. We're up by 8 basis points, just shy of the 2-year. The 10-year up by 6 basis points. We spoke to Pooja Kumra from TD earlier on the gilt side, and she was saying, look, it doesn't change our expectations really for Thursday. We've got other data to come. It's not as if anyone's going to suggest that on the back of this high wage data we get a hike. So, hold was the expectation. That remains the case. But what difference does this kind of data make to the longer-term picture for the UK? I mean, rates not coming down as much as we'd expected next year, perhaps?
Yeah, I mean, I've never really bought into this whole idea that UK inflation was going to tail off nicely and the Bank of England were going to be able to be taking rates down considerably. The UK, the labour market is structurally changed post-Brexit. When we were a member of the EU, we had this perfect elasticity. Whenever an industry ran out of workers, they would just arrive almost instantaneously from the continent. And that really gave us what economists call the flat Phillips curve. Very little wage growth, no matter the conditions of the economy. We're just not in that world anymore. Yes, we still have migration, but that frictionless labour market that we had from migration from the continent is just not there. We are in a very different world in how our labour market behaves. And even though activity is weakening, we're seeing activity weakening, we're seeing the labour market weakening, I don't think we're going to see that coming through in wage growth. And this puts not only the Bank of England, but the government in a very difficult position because, of course, the national insurance hikes, I think there are going to be questions. Is that contributing to this weaker growth, higher inflation combination we're looking at.
Yes, until that point, Kriti, we're just seeing a headline across the Bloomberg terminal saying traders now see less than a 50% chance of a third Bank of England cut in 2025. So the effect of that wage data dialing back those expectations of cuts next year.
Yeah, I wonder how much the liquidity story plays into all of this on both sides of the Atlantic. And Karen, I pose this question to you because we talk about it all the time in the context of central banking and the QT, et cetera. But you mentioned the trillions of the tech boom, et cetera. How much of that is just a liquidity play at the end of the day?
So I certainly think, I mean, this is where things like gold and Bitcoin have a lot of signaling context, like how much cash is still washing around there. We see it as well in our money market funds. You know, there's still a heck of a lot of cash out there, either working or waiting to be put to work. And that does play into, I think, general attitude to where we expect how risk will be supported. It's one reason we're very constructive. But, of course, where that liquidity is flowing is the really important question. It has been flowing to the US, as we know, in all asset forms, and that's why the dollar is also so strong, because of demand for those US assets. Does that continue through the course of next year? I'm not so sure.
It seems to be the market has been quite quick to price in some of the positive signals from the incoming Trump administration around what could be done for growth in terms of tax cuts and a focus on growth and other positives in the eyes of investors, and less quick to factor in the negatives. What do you worry about as we head to 2025, Karen? I hate to leave it on such a negative, but as we head into next year, and you clearly seem concerned about valuations in the US and tech stocks in particular. What is it that changes the story there?
Well, I just think we have to remember this is not 2016, and running the same playbook, I think, is risky. So, you know, he came into office last time with inflation that was stuck below target and a 3% deficit. So slashing taxes and whilst also doing some tariff policy was very beneficial for the US and very good for corporate earnings. However, now we've got a 6 to 7% deficit and inflation stuck above target. So there's just that slight risk if he does try to, and we don't know exactly what he will enact and what versus what he's said on the campaign trail. But if he does try very hard to run that same playbook and really deliver on those campaign promises, we could see the unintended negative consequences. We could see inflation staying stickier and consequences for the Fed. We could see inflation staying higher and the consumer not being happier about that. And we could see the bond market unhappy if he really starts to talk about further tax rises. So I just think there's perhaps too many investors running the playbook of 2016, and I just think the world is different.
All right. Karen Ward, pleasure to have you on the program. Chief Market Strategist for EMEA at JP Morgan Asset Management. We look forward to having you back very, very soon. In the meantime, a quick check on those core six. Karen was talking about the Mag 7. Let's talk about Europe's equivalent here. Red on the screen for most of the companies that we've got our eye on. Novo Nordisk is the underperformer this morning, down about 1.7%. We're going to dive into the details of that stock in just a moment. Ferrari also taking a little bit of a beating, down about 1.4%. The rest is kind of sanguine. Even LVMH down about 0.4%, maybe in line with perhaps that China read-through, but then also that French political overhang as well. That's just your core six. I hope I did Guy a little bit of justice there. Let's get a check on some of the individual stocks on the move. Joe Easton.
So one of the best performers today is here in London, and it's Canal Plus. Now, remember, this stock did list yesterday, spun out of Vivendi, had a bit of a rocky start to trading it yesterday, but gaining today. There is some analyst commentary on the potential growth in its subscribers. It, of course, the French television company, as I say, spun out of Vivendi with a market cap around 2 billion, one of the best performers on the stock 600 today. Then in terms of healthcare, we got an update from Sandoz. Now, this is a generics firm saying that it's going to pay around $275 million to settle a case related to antitrust in the US. That's a company, of course, spun out of Novartis, and that stock actually hit this morning, coming up a little bit, was down around 1.5% at the open, but coming up now down 0.4% for that one. But one stock getting hit quite hard today is Bunzl. Kriti touched upon that one earlier, reporting a bit of weakness in their top-line sales growth. It's the UK food distribution company, a £12 billion billion company, and on the FTSE 100, but the worst performer on the FTSE today, coming down 5%, a pretty sharp move lower in that one. Then in terms of those other UK stocks, as Karen was discussing, the potential outlook for sustained UK inflation following that wage data, and we are seeing some weakness in the home builders and a little bit in the banks as well. Of course, we will get CPI tomorrow and the Bank of England on Thursday, as we said earlier, but continued losses for the home builders at the moment. Then in terms of the rating changes, did want to take a look at Airbus. This was another one mentioned earlier now. Airbus up to buy at Deutsche Bank along with Safran. Both of those companies are upgraded, but it's the outlook for deliveries at Airbus which is better than forecast according to Deutsche Bank, and the valuation looking pretty good as well according to them. The other one, this one hit by a Goldman Sachs downgrade. We've got JDE Peet's, the coffee company, reinitiated at sell over at Goldman. They say that a 65% jump in the price of coffee futures in the second half of this year is going to hit the company, and that one is declining today over in Amsterdam, down 2.8%.
Very appropriate for this time of the morning. Thank you very much for that one. Joe Easton ending on the coffee news from our equities team, of course. Coming up on the programme, why the rapid rise of weight loss drug maker Novo Nordisk has hit small businesses in Denmark. More on that story next. This is Bloomberg.
We need to get better cooperation between the private markets or you know, the business world and the political world. And I think that cooperation hasn't been that good for the last 5 or 10 years. So hopefully there's an opportunity also, you know, with that Draghi report in mind and what's happening in the US in mind, to drive capital, to drive change. It's really needed for society.
Christian Sending there of EQT Partners CEO, really commenting on this idea that PE could come to the rescue of some of these fiscal governments that are perhaps trying to offload some of their infrastructure deals. That's exactly what's happening at deals like in Italy. News that CVC Capital Partners is exploring a potential purchase of Vivendi stake in Telecome Italia. It could pave the way for a takeover of Italy's biggest telecommunications company. Let's get more out of Paris from Bloomberg's Benoit Berthelot. Benoit, pleasure to have you on the program. I'm a little obsessed with this deal, as my team knows. CVC has made this bid before and been rejected before. Why is this time different?
So it's different because Telecome Italia has been struggling lately, has a big debt, and last summer finally broke a deal with KKR to split the network, which was the best valued part, a 22 billion deal. So now what remains is the consumer unit of the company, and this is attracting fresh interest. Now, we report that the stake that's reportedly for sale is Vivendi's stake. The French media company has had this stake for a long time. It's been a pain for the company, and they're just at the moment where they are themselves splitting and reconsidering their stakes in other businesses. So CVC, as we report, would be interested in buying that stake, and later on could buy a more important stake or just buy the remaining of Telecom Italia. And they could find value in that business because there is a consumer unit, but there is an enterprise business, and there is a Brazilian unit as well. So they could find the inner value of this asset.
Yes, so that's why CVC is interested. Benoit, why does Vivendi want to find a buyer then for this stake?
So Vivendi is just in the middle of an overhaul, really. Just yesterday, as we just discussed, you know, they've been spinning off 3 units. Canal Plus is their pay TV business that they've been listing in London just yesterday. There is an ad business, Havas, that's been listed in Amsterdam, and there is a publishing business listed in France. So the remaining of Vivendi is really now a portfolio company, still listed in Paris, still called Vivendi, and it has that Telecom Italia stake. It has a stake in Universal Music, for example, but it's clearly a new phase for the company and for the billionaire Vincent Bolloré and his family, and they're more free now to reconsider what they want to do with all these stakes that are just in a portfolio company now.
OK, Benoit, thank you very much for bringing us the latest twists and turns of this complex, long-running saga. Thank you, Benoit Berthelot, joining us there from Paris. From Paris, let's go to Copenhagen. In Denmark, Novo Nordisk's rapid hiring spree is making it difficult for small businesses to find staff, forcing some to close down. Let's bring in Bloomberg's Sanna Vass, who is in the Danish capital and can talk us through the story. So, Sanna, Novo Nordisk is the #1 driver of GDP and job growth in Denmark. It's a big player on the index, of course, of Danish stocks. Tell us more about the fight for talent in Denmark.
Yes, well, Danish economy is doing well. Employment is at record high thanks to Novo Nordisk. And of course, that's positive for Denmark overall. But it's also not everyone who's benefiting from this. Denmark is a small country. We're about 6 million people. And Novo Nordisk is on such a massive hiring spree at the moment that they're vacuuming the labour market for everything it can get. And Novo can attract a lot of employees. They offer attractive salary, good benefits, and it's a place that people want to go and work. But for other companies, especially in those areas where Novo is present and expanding, it's causing a lot of struggles, especially because businesses are losing staff to Novo and they're struggling to recruit. And it's not just pharmaceutical peers, it's across the board. We're seeing schools, public hospitals, armed forces, auto repair shops losing staff and struggling with this. So it's really starting to cause some pains.
What are the consequences, though, for the Danish economy? When you talk about these kind of struggles and these pains, what happens after?
Yeah, well, for some businesses, it means that they just can't grow as much as they would have liked to or would have been able to. We're seeing some having to reject orders. Others are having to delay expansion projects because construction companies can't find enough staff. I also spoke to a company that decided it was easier to just move production abroad, and another that decided that he could simply not continue that way. He was just exhausted from having to recruit staff. And he closed his shop. He was based just half a mile away from Novo Nordisk. It was a car service shop. And so that's, of course, bad news for those businesses, but also for the Danish economy as a whole. It means that growth is very much centered around this one company, Novo Nordisk. And it does create some risk of concentration that could become a problem later on.
Sanna, thank you very much. Thanks for joining us. Bloomberg's Sanna Vass there in Copenhagen with the many ways, then, Kriti, that the Novo Nordisk story impacts on the Danish economy, talking about the labour market, putting the labour market front and centre there. But, of course, we've talked about the weight that this has on the Danish market, of course, the stock market, and the impact it has there. So this such a large business, and there are quite a few notable large businesses in Denmark, but some of them having this outsized influence on what happens in the Danish economy.
I think I read a Goldman note somewhere that Novo Nordisk specifically was contributing, I think, 60% of their entire global GDP, and 60% of the Novo income comes from the United States. It's a very interesting ripple effect from economy to corporate to economy again.
OK, coming up on the programme, we will focus back in on some of the latest developments in China and how they're likely to impact or be influenced by commodities markets. We'll make that link shortly. We'll be joined by Max Layton, Global Head of Commodities Research at Citi. This is Bloomberg.
This is the opening trade. We're at 30 minutes in today's session, and it's looking to be a little bit of a poor session for some of the bulls. You are seeing red on the screen, a little underperformance in France. This has been the theme that we have seen for the last couple of days, but perhaps a little bit of green on the screen in other parts of the markets, although I think I said that too quickly. When you look at the commodity markets, it's a similar story. Risk sentiment, I think, across the board is where you are seeing a lot of pain. Oil right now at about a 73 handle, just shy of 74. Let's go there. Oil steadying, of course, on the back of lackluster economic data from China. Crude set to end the year modestly lower on expectations of a glut next year. Max Layton, Global Head of Commodities Research over at Citigroup, joined us around the table. I was hoping for a little bit of optimism because I feel like a 74 handle is still maybe one of the strongest levels we've been at in a couple of weeks here. But walk me through the oil story. How much of it is China? How much of it is really the United States?
Well, yeah, the oil story overall, the market we think is broadly balanced. this quarter, and it's going to stay broadly balanced for the next quarter as well. So it's quite vulnerable to any kind of supply disruption, whether it's Libya or fears of supply disruption in the Middle East. On the demand side, yeah, some good news from China with the 5% target, well, at least that being mooted by some media outlets this morning. And, you know, that's supporting things as well. So for a while, oil's going to hold up. This big surplus doesn't really hit until the second quarter.
How believable is that China story? We talk about it all the time in terms of every time we get China headlines, it moves the entire commodity complex in the stock market. Shell, BP, Rio, Glencore, among many, many others. But we're still wondering about that believability factor. It's enough to move the markets, but is it enough to deliver?
Yeah, we don't think it's enough, right? So in historical context, when China comes out and does a major stimulus, you're talking about the credit impulse going from something like negative 5% of GDP up to 10% of GDP, so a 15 percentage point swing. The kind of fiscal stimulus and credit easing that we're talking about is 2-3 percentage points. So it's a tiny fraction of the stimulus we saw in 2016, for example, or in 2020. And it's probably enough to, you know, support things, some things, but it's not enough to offset, for example, the trade war that is highly likely to start in the first quarter.
Max, what about the oil intensity of the Chinese economy? Tell us a little bit about that, because we have, you know, we're used to watching China very closely as one of the big drivers of the oil price, along with many other areas of the global economy. But then we talk a lot about China pivoting towards EVs and moving away from that kind of energy product. So talk big picture about how China responds now, or how China drives, rather, the oil price at this point.
Yeah, I mean, there's a great point. The oil intensity GDP slowed down dramatically in China. And, I mean, one thing we've been super focused on is how China is overcoming a lot of the problems that we talk about outside of China with respect to electric vehicles. And this is all kind of rapidly happening over the last 12 months. So intensity or penetration rates of electric vehicles in China have gone from around 18 months ago, they're around 30-35%. They're now getting up to 50 to 55% on average last month. I mean, it's almost doubled in terms of penetration rates, and that's significantly slowing oil demand growth, because when you're adding to the pool of cars, you're adding cars that aren't consuming oil, and you're scrapping cars that did consume oil. And for the ICE vehicles you do add to that fleet, they tend to be more efficient in their oil consumption. So, yeah, the car fleet's a big issue for oil demand.
And so you have a quite bearish forecast for next year. You're talking about seeing oil going as low as $60 or lower by the middle of 2025, I think. Right. I mean, what's the key driver of that then? Is it that China story?
Yeah, I mean, you know, we're not particularly enjoying being, overly bearish on anything, really. But, the only thing we dislike more than being bearish is wrong. So there's a lot of things going wrong with the oil market. Basically, when we line up the base case, this market has slowing demand growth, significantly accelerating supply growth. The supply growth is coming from more than 10 non-OPEC plus countries, so it's very broad-based. There's overcapacity. And, the US economy has been slowing down now for 2 to 3 years. China's weak. They've got the trade war. What haven't I mentioned? There's the potential for geopolitical problems that we've had all year to at least dissipate, or at least come off to some degree, and the potential for grand bargains as well. And, so I mean, the list is really quite long. Having said that, we're not bearish forever and down to $50, and there are a lot of countries that are growing their oil demand, whether it's India or a lot of other Southeast Asian countries. So, we've got it stabilising at $60, which, I mean, it's not an amazing price, but it's not as bad as some of the bears out there.
Okay.
Yeah.
Well, you talk about the slowing dynamic in the United States as well, but there's also a conversation that there'd be an inflation tick-up in 2025, potentially into the rest of the year, because of the geopolitical tensions that you actually mentioned. The last time we saw that inflation tick-up, commodities were the place investors went. Even if they weren't actually commodity traders, they wanted that exposure as an inflation hedge. Do you see a repeat of that?
Sure. I mean, inflation's holding up. Our house view is US inflation does continue to gradually come down over the next 6 to 12 months. Gold's in a little bit of a Goldilocks situation, so I'm kind of shifting the answer towards gold, because I think whether inflation comes down and the Fed starts cutting rates, or whether inflation surprises to the upside and the Fed keeps rates higher for longer, people are going to be wanting to add to their gold portfolio over the next 12 months because, frankly, US growth, US labour market's been slowing down for a couple of years. And until that puts in a bottom, until that, starts to turn around and people start to get more confident about global manufacturing, US manufacturing, people are going to want to hedge against that potential for equity downside. Equity's had an amazing run, and a lot of that has been because of the resilience of the US economy. So at some point, maybe there's a turn, but until that point, gold's going to catch a bid, kind of like 2007. What happened in 2007?
Right. You go back to 2007. I was looking at some comparisons back to 2010, Max, because we've seen a 29% or so increase year to date in the gold price. That is the biggest increase since 2010 in the wake of the GFC and in the run-up to the European debt crisis. What are you watching? What's going to change on the gold story for you? So maybe the geopolitics. Yeah. What about the central buying narrative, that impulse to buy? Is that going to remain?
Sure, yeah. I mean, a lot of the drivers of the gold bull market this year, I mean, they're highly unusual in the sense that real rates have been correlated with gold for a very long time and rarely broken down in the last 15, 20 years, but it's completely broken down the last 2-3 years. So the last couple of years have been all about central bank buying and hedging US downturn and global downturn risks for us. And we've quantified that in this gold investment as a share of mine supply framework. And essentially, this single variable explains most of the variation in the gold price over the last 55 years and certainly explains this recent bull run.
Is there an argument to be made that gold has rallied too far? That if you're going on a valuation perspective and everyone is looking for this trade, this is the exact time to pull out. When I'm looking at a precious metal that's at 2,646, that's pretty high.
Yeah, it's done really well, but I guess I would just counter that by saying US interest costs for the government of the US have been going up by 0.6% of GDP for 3 years straight. It's now 1.1 trillion on its way to 1.3 trillion. So the US has government budget issues, which they may solve by cutting spending significantly, which would obviously potentially lead to a downturn in the US, which will lead to more gold buying, or they don't solve the problem and you have this kind of high interest rates hurting global growth and eventually lead to a US downturn anyway. So the point is people want to hedge, I think, their very strong profits they've made in equities and the significant downside risk there over the next couple of years. And yeah, it's expensive by historical standards, but I think it's got a lot more to go.
Max, thank you very much. Max Layton, Global Head of Commodities Research at Citi. Coming up on the programme, political uncertainty in France weighs on the country's economic outlook. We're going to be hearing from Valérie Pécresse, Paris Region President, live at the annual conference de Paris. That's taking place today. Francine Lacroix is there for us. This is Bloomberg. Welcome back to the opening trade. 42 minutes into a European session where sentiment seems to be fading just a little bit. We are certainly seeing some weakness coming through on the London market, down by 0.8% on the FTSE 100 today. Energy stocks in focus and moving lower. Now to the political uncertainty in France that has weighed on markets, certainly in yesterday's session. It's been weighing on the country's economic outlook as well. We've been talking a lot about the bond markets, of course. Lawmakers unanimously then adopting a stopgap budget. That's intended to keep the state functioning through January. In the meantime, waiting to see whether the new Prime Minister can deliver a more permanent budget. This, as business leaders gather for the annual Conférence de Paris, that's aimed at fostering international trade. Let's go to Bloomberg's Francine Lacroix, who is there. Good morning, Fran.
Anna, good morning. Joining us now is Valérie Pécresse, the Paris Region President. Of course, she's one of the most well-known politicians for a long time here in France. Madame Pécresse, thank you so much, as always, for joining us. You just got back from a big trip and speaking to investors in New York. I imagine they probably looked at you with wide eyes and saying, what's going on politically in France? How did you reassure them?
Yes, I went to New York to reassure some of our partners because, as you know, after Brexit, we had 6,000 jobs relocated in the financial sectors. And we want them to feel at home in France and to feel safe in front of political instability. And as you say, they ask me a lot about the French situation. And what I wanted to tell them is, first, of course, the fundamentals of the French economy are good despite the instability. Second, we have safety net, institutional safety nets, which prevent us from having any shutdown, having any drama, economic drama in short term. And third, I'm sure that the government has in mind that we have to undertake structural reforms in order to get stronger and to face up with the challenges of the future.
It's early days, but what is the way forward for this country to be competitive, and how difficult will it be to find a budget? You've, in the past, put many budgets together.
Well, what I did in the region, when I was elected president of the region was nearly going bankrupt. We had a huge debt, we had deficits, we had infrastructures that were completely rotten, and we had to redo everything. But what I think is that France is very rich, so we have to put public spending efficiency at the core of our reflection. And that's the message I'm sending to the French government. It's in France, but it's also in Europe, because Europe and France have this tradition of over-regulating all the time. We have issued 3 times as much regulations as the American Congress in the past years. And we know that with Donald Trump in power, Elon Musk, after having the IRA, we're going to have another wave of deregulation in the United States. And we know that the Americans want to attract the talents of France because we are a huge talent pool. We are very much into AI, quantum, biotech, new space, new nuclear. We are the region in the world, one of the best regions for innovation in the world. And I'm afraid, of course, of these talents going to America if we cannot deregulate and help them innovate.
But Madame Pécresse, what does the Paris region need from the new government today? Do you worry that finance, global finance, be it American finance in France or even French finance, will move elsewhere if there's too much regulation and if there's not stability politically?
We have now a report, the Mario Draghi report, which gives all the ways of reforms, all the roads we have to take. So we know what we have to do. The problem is now that the engine, the French-German engine, has stopped. It has stopped because France has got political problems and Germany has got political problems. We have to solve these problems fast. In Germany, there will be general elections in February. In France, we have to find the ways of a stable government which enables public efficient, a reflection and an action on public efficiency.
How often were you asked by a lot of the American investors to explain the French Parliament to them? What was their number one question to you?
Well, first, we had a good news to tell them because we had a prime minister on Friday. So the beginning of my trip was more complicated than the end because at the end we had a government, we had a prime minister. But I was telling them that nevertheless, the safety net, the institutional safety nets are very powerful. We have a very strong state. We succeeded in making extraordinary Olympic Games during the summer. We succeeded in rebuilding Notre Dame in 5 years. So when we want, we can, even if we don't have a government, because during the Games we didn't have any government. But the political crisis is still very bothering because it prevents us from doing structural reforms that we need. And I will go on advocating for these structural reforms. But what I told my interlocutors is that in Ile-de-France, there is also a pool of stability because local governments account for 80% of French investment. So in the local government of Ile-de-France, which accounts for 1/3 of French GDP, we are stable until 28. It's under my government. We are pro-business. We are technophile. We want to help enterprises, and we are still building a super metro. We're still working a lot on the environment of the firms we host, and we hope they're still very happy here.
Madame Pécresse, the latest GDP projections actually show that the effect of the Paris Olympics are very short-lived. Are you disappointed with that?
No, they're not. It's deeper than that. We expect an extraordinary touristic season next summer. We expect that all the incentive trips in America will be in Paris because Paris showed itself at the best. Yeah. So we think there will be a long-lasting effect.
And Emily in Paris. Is that is that actually the best advertisement that you could have?
The best advertisement is the beauty of the city and the surroundings, and that's what I'm working hard on.
I mean, how difficult is it to lobby Emily in Paris to stay in Paris and not in Rome?
Well, no. Paris speaks for itself.
Valérie Pécresse, thank you so much for joining us. That was, of course, Madame Pécresse, the Paris region president. With that, I'm going to send it back to you, Kriti, and then we'll have plenty more from the Conférence de Paris throughout the day.
Bloomberg's Francine Lacqua there with that exclusive interview. We really appreciate it. Let's stick with the conversation in Paris and go to the Bank of France, which has cut its domestic growth outlook for next year due to the country's political turmoil affecting household and business confidence. Bloomberg's Phil Serafino joins us from Paris. He's all over the story. Phil, walk us through this cut to the growth outlook. Where did it go wrong for them?
You know, the Bank of France is saying that the political uncertainty is really weighing on investment and consumer spending. You can imagine if you were a business owner and you're deciding whether to hire people, you might hold back, given that you don't know what the tax situation is going to look like next year. You don't know what government spending is going to look like next year. So, you know, the Bank of France has dialed back its growth expectations, both for 2025 and 2026. You know, 0.9% growth. That's not enough. France needs a really growing economy to help it get out of this deficit hole that it's in.
Yeah, absolutely. We've talked about that many times, haven't we? And Phil, talking about the deficit hole, many politicians have been trying to fix that, but it's proved difficult, as we have chronicled. What challenges does the new Prime Minister Bayrou have ahead of him then? We understand he's been talking to Le Pen. She feels listened to. He's been talking to the socialists. A lot of conversation happening, but what are the challenges that now exist?
Well, the big challenge is the sort of jigsaw puzzle that is the French Parliament. No one has a majority, and you have some very different political views there. The far left has a big bloc. Marine Le Pen's far right has a big bloc. Bayrou needs to come up with first a government and then a budget that can keep all those people happy. And I mean, the big challenge really is there are no easy answers. The governor of the Bank of France, François Villeroy de Galhau, in putting out this economic report last night, he's out doing the media, and he's giving a message that politicians really don't want to hear. I mean, his point is France is spending too much money. And, you know, France spends about 57% of GDP on its government. The average in the Eurozone is around 48%. And he says, you know, that's great. France has wonderful government services, but we have to cut that back and we have to raise taxes a little bit. So that's the challenge for Bayrou, how to do those things, neither of which would be very popular.
So, Phil, the great thing about you is you get to cover a little bit of politics and a little bit of the markets as well. So marry the two for us here, simply because we've been talking about this underperformance of the CAC 40. I want to say for at least 6 months now, since those snap elections back over the summer. When does France catch up? What does the equity market investor need to see from France to say, all right, we're gonna reinvest in this index?
One problem the French stock market has is, I guess this might be a good problem to have, it's very international. There's a big chunk of the CAC 40 companies that don't depend on France. You have companies like LVMH, Airbus, they are global companies. But the problem for them is outside of France in many ways. China still not growing very well, struggling to stimulate the economy. And then there's the prospect of tariffs from the U.S. So it would be great for the French stock market if France got its budget situation under control and the politics were stable. But there's a whole lot of outside forces out there, too, that are sort of weighing down this stock market.
Phil, thank you very much. Phil Serafino bringing us the latest from Paris, Kriti, on both the economic story and indeed on the politics.
And in the meantime, we go to some news out of Russia as well. Igor Kirillov, the head of Russia's radiological, chemical, and biological defense troops, was killed in a bomb explosion in Moscow earlier today in what appeared to be a rare assassination of a top military official in the country. A source tells Bloomberg that Ukraine was behind the killing, and it comes one day after Ukraine's SBU security service had accused him in absentia with ordering the, quote, massive use of banned chemical weapons against Ukrainian troops in the country's east and south, something we'll be monitoring very, very closely.
Yeah, absolutely. All of this in the context of what we know President-elect thinks of this ongoing conflict, and he's reiterated his urging of Zelensky to prepare to make a deal to end the war. So we'll watch that with interest, of course, as we head towards January and beyond. Let's get back to what is happening here and now. And in terms of the data releases, we are expecting a couple of key data releases from Germany this morning. 9 a.m. and 10 a.m. we'll get the IFO and we'll get the ZEW out of Germany. So both of those data prints will be important, given we're watching the politics, how that develops. Looks as if it could be quite a while, Kriti, until we get any kind of government in Germany, even when we get the results of the election. Of course, coalition building, if that's what it takes, often takes a while. 1:30 p.m. UK time, we'll get US retail sales, and we also get Canadian CPI, which stands out, of course, because we've got a lot of politics in Canada playing out. Yet another jurisdiction where we've seen the election, once again, of President Trump having an impact on domestic politics.
Yeah, and the Canadian makeup is really interesting because, one, they're extremely exposed to the commodity story, which we were just talking about with Max Clayton as well. They're also exposed to the housing story. So if you see the inflationary issues in the United States, you're going to see it reflected in Canada as well. But really for Europe, it's what's happening in 5 minutes, as you mentioned, this idea that we're going to get the German economic data at a time, by the way, when the euro dollar is at a 104 handle. We're spiraling to parity so quickly, and I'm not really sure anything can rescue it.
I mean, I suppose quickly. Yeah, I mean, I feel like it's been at 105 for quite a while, but maybe a deeper dive into the charts would prove I'm wrong there. But 104, as you say, and a 92 is where we trade right now. So we're waiting for this IFO number. That's the one that comes first, and then we get the ZEW. In terms of the IFO, those business expectations are going to be key, and we are expecting them to kind of stay where they've been. 87.5 is the expectation there, Kriti. So not expecting to see a big uptick in sentiment, as I suppose you would expect in a country that is now confirmed to be going to the polls at the start of next year.
And I think it's also fascinating here because it's coming at a time where we're also talking about the debt brake and the removal of the debt brake. And it's something that we were talking with Pooja Kumar as well, where this kind of potential for investment that these surveys are indicating is very, very badly needed is something that the debt market isn't actually factoring in.
Yeah, or at least the reform of the debt brake. Yeah. And we keep getting these messages. Do they conflict, or are they quite nuanced from the CDU, CSU about their willingness to tackle that debt brake? Maybe just to reform it rather than scrap it seemed to be the latest news flow. But we are going to be hearing from them a little bit later on. So we'll hear from the right of German politics. We'll also hear from the SPD, I think, as well, also giving their platform for the next election. We will be live in Paris. We just were in Paris with Francine, and we will be live again there later on today. The annual Conférence de Paris continues, including interviews with the Emeritus Chairman of Publicis Group, Maurice Levy, who will be joining the team on the ground there, as well as the BHP CEO, Mike Henry. That is it for the opening train. The Pulse is up next. Have a good day, everybody. This is Bloomberg.